Hello everyone, welcome to my PowerPoint presentation. It's on sensitivity analysis versus capital budgeting analysis. I'm going to cover some of the basics in about 5 minutes. My name is John F. Hamilton. I'm a graduate student at American Public University. I just received my graduate certificate in neuroleadership, and now I'm moving on towards my master's degree in management. It's Business 604 Fundamentals of Business Analysis with Dr. Wu. And first of all, sensitivity analysis, there's 6 steps. Now, what are the quantitative and qualitative steps? The first question you want to ask is, does the project have a good potential return on investment? So step 1, identify your key variables. Which variables that you input would change the output. Step 2, define your range of variables. So in other words, what will be your parameters? Step 3, create various scenarios. Try different combinations of these inputs and outputs. Be creative. Step 4, run simulations. Try out each scenario while recording your data. Step 5, analyze your feedback. You want to compare and contrast your input variables with your output variables. And then step 6, make your conclusions. Evaluate how each of your input variables impacted those various output variables. Okay? Now, uses of sensitivity analysis, climate and weather models. That's very common these days. We've got a lot of television channels that offer the weather, and as well as online sites. Very helpful. Design and engineering. Engineers can use these sensitivity analysis for different types of modeling, other research and science. And in the finance world, return on investment, your ROI, which is what we're mostly dealing with in this class. Now, these are scatter plots of sensitivity analysis. You can see Z1, 2, Z3, and 4. It looks like Z4 is the tightest. See, it's got the most defined shape, dark in the middle. Then Z3, these two are close. Yeah, I think Z1's a little bit darker in the middle, so this one's the least tight, the most scattered, in other words. Okay? So you can compare them with one another. Capital budgeting analysis. Now, this is different than sensitivity analysis. Instead of 6 steps, there's 5 steps. Now, capital equals money. A budget equals plan. Therefore, capital budgeting logically equals a money plan. And capital budgeting analysis means money plan analysis. So it sounds like common sense, but invest in projects in which earnings exceed expenditures. Okay? We're not reinventing the wheel here. Capital budgeting analysis, there's 3 types of risk: financial risk, project risk, and strategic risk. Financial risk, that encompasses stock market changes, creditworthiness. Project risk, supply prices. We know the supply chain issues have been going on since 2020, since the pandemic began. Unforeseen weather, document errors, employees, equipment malfunction. You never know when something's going to break down, right? It's always going to be the copier, right? Okay. Strategic risk, economic fluctuations, upgrades by competitors. You never know when your competitor's going to come out with that better phone. And technology and advances. It's 2024, and technology is just, it's speeding up every year, quicker and quicker. Note, capital budgeting is known by the name investment appraisal as well, so that's the alternate name. 5 steps. Step 1, identify your possible projects. Step 2, develop your potential costs. Step 3, select or reject your project. Step 4, implement the project. And step 5, continue to monitor your progress. Multinational capital budgeting. MNCs involve different currencies. It's a global economy now, right? Convert your earnings to present values. Remember, time has present value and future value. Okay, so you have to keep that in mind. And inflation can be a factor as well. Currency value fluctuations can ultimately affect your profits. So that's why you want to know these things. Net present value. This is not too complicated either. If the net present value MPV is positive, approve the capital investment. If the net present value MPV is negative, do not approve. Okay, so 5 methods to value projects. You can use the PB, which is the payback period, or the DPB, the discounted payback period. You have the IR, internal rate of return, MIRR, modified internal rate of return, and the NPV, we just spoke of, the net present value. Okay. Calculating a budget requires all available figures. That sounds pretty common sense, but the point to keep in mind there is don't just use one set of data. You use everything. Use all of your different sets of data to make a wise decision on investing, whether you should invest or not, get involved in a project. Okay, in conclusion, Sensitivity analysis is often used in combination with uncertainty analysis. Sensitivity analysis features your input variable and your target variable. Capital budgeting analysis, on the other hand, is known by the term investment appraisal. And capital budgeting analysis is a type of money plan. You have three types of risk: financial risk, project risk, and strategic risk. Okay? And there's your references, your image citations, the end, and thank you for watching my PowerPoint presentation. Goodbye.